Welcome back to Squawk Box. Dramatic moves for recent IPOs hitting the market. Check out the Renaissance IPO ETF. It's roughly the top 80% of new companies that go public. In the last year, it's more than doubled, far outperforming the broader market. Joining us right now to talk about this IPO landscape, an exclusive interview is Joe Lonsdale. He is 8VC founding partner. He's also co-founder of Palantir and an early investor in Wish and so much more. It's nice to see you, Joe. We keep seeing these high-flying IPOs. You saw the Airbnb numbers. You saw the DoorDash numbers. You saw this Chinese company just yesterday up 400%. Does this make sense to you? What's going on?
Well, there's a couple things going on, but it's clear the market's really undervalued a lot of these durable tech platforms for many years. I mean, just look at the backward-looking returns on the top tech companies that have big moats, and people are realizing, wow, some of these companies are doing things that are newly possible, and they're worth a lot. So I think people, when they're looking at this, sure, there's a lot of money around, but there's also a lot of good reasons for these tech platforms to sometimes be worth more than people intuitively understand.
So if that's the case, though, do you look at the underwriters of these IPOs and say that they are doing a disservice to the companies that they're working for in terms of how they're valuing these companies and telling them what the value is in terms of how they think the market's going to go? And then, of course, you see it skyrocket, a lot of money being left on the sidelines?
I mean, the job of the bankers here is very difficult because you don't want to aim so high that you then break things, because your number one job is to get it done and get them out. I think they should use more auction mechanisms. There's a lot of ways they could use auction mechanisms to price it versus just giving. Obviously, the way it works right now is their friends get to invest and people who know them well get access to these things. So I think, yeah, obviously there's ways they could change the traditional way of how you do these things. But I mean, not every one of these things has skyrocketed right away. The market doesn't always understand all of these companies, and it's not obvious to the bankers what it's going to do. So I think we're maybe a little too hard on them. But I do think there's new mechanisms we could be using.
So 12 months out from now, 24 months out from now, you think we're going to look at these values and we're going to say this was a floor and they're only up? You think we're going to look at this vintage and say it was a bubble? What's the prognosis?
Venture capital is a very disparate asset class. There are some of these companies that are highly durable companies that have great margins and very good business models that are clearly going to keep working for the next 5 or 10 years. And there are some of these companies that probably been helped a lot by the business climate right now, making deliveries or whatever else they're doing that maybe aren't going to be doing quite as well in a couple of years. And so I really do think it's one of those things where you have to be looking at the companies themselves and be very careful.
Shepard Smith here. Thanks for watching CNBC on YouTube.